Hello traders and welcome back to another video of Nova Forex. There are a lot of fair value gaps being created into the market, but all the fair value gaps aren't respected, and thus, it is important to identify the correct fair value gap into our charts in order to make nice profits from the market. So, in this video, we would share the best fair value gap strategy that you can use in order to make huge profits into the market. Now before we start the video, if this is something that interests you, then be sure to subscribe the channel and hit this bell icon to never miss out any of the upcoming videos which are being uploaded on the channel. Now let us commence the video. So, first let us look at some of the basics of the fair value gap before learning the fair value gap strategy. We would learn all these things in this video. Let us begin with the first one, which is how to identify the fair value gaps. The fair value gap forms when the market makes one big candle with big body and small wicks like this, and small candles before and after it. This gap between the previous candle's high and the next candle's low is called the fair value gap. The fair value gap indicates that there is a lot of buying or selling pressure from the market participants, which resulted in creation of these big candles with small or no wicks. And also, this indicates that the buyers have taken the control of the market, which is why the market made a big bullish move by making this big green candle. Now let us look at the types of fair value gaps. There are two types of fair value gaps. The first one is the buy-side imbalance and sell-side inefficiency, and the second one is the sell-side imbalance and buy-side inefficiency. In the first type, which is buy-side imbalance and sell-side inefficiency, the market firstly forms three bullish candles, which signals that there is an imbalance between buyers and sellers into the market. After seeing this FVGs forming into the market, we should wait for the market to reach at this gap in order to take buy position into the market. The market made a pullback and reached at this fair value gap. And then the market reversed, and thus, it continued its uptrend. Similarly, in the second type, which is sell-side imbalance and buy-side inefficiency, the market firstly makes candles like this, which has big bodies with lower wicks, which creates the fair value gap. Now that we have drawn the fair value gap from this candle, let us wait for the market to reach at this fair value gap zone. The market reached at this zone, and thus, we would go short from this point. And as you can see that the market went below after reaching at this zone, and thus, we made huge profits into the market. Now let us learn the concept of consequent encroachment. The consequent encroachment simply means the midpoint of the fair value gap. Let us learn about this in depth through an example. So, here as you can see, market made this big bullish inefficient candle. Now let us draw the fair value gap. Now let us wait for the market to tap into the fair value gap. The price came inside this fair value gap, but at this point a lot of traders would get confused that whether to enter now or should we wait for the market to go a little bit lower. In such a situation, the consequent encroachment concept would help you. We would set our buy limit order at the 50% of the fair value gap. The stop loss would remain below this fair value gap, and the target would be at 3 times the stop loss. As you can see that by using this concept, we made huge profits into the market. The consequent encroachment concept is very useful to the traders, as the market makes big fair value gaps a lot of time. And which is why the traders gets confused and does not initiate their buy trade into the market, and even if they do initiate their trade into the market, they would keep their stop loss at the consequent encroachment or above it, which is why they get stepped out of the market as the market reached at the 50% level and then it went above. And also, when the market respects the consequent encroachment by going to upside when it reaches at this point, it indicates that there is a strong buying pressure into the market. Now let us see one more concept of the fair value gap. In this concept, we would learn about how to identify the correct fair value gap when the market forms multiple fair value gaps at the same time. Let us learn this concept through an example. So, here we have the gold chart on 4-hour time frame. We can see market making multiple bullish imbalance candles here. Now we have these 3 fair value gaps here. A lot of traders would get confused when such a situation occurs into the market. We would use the premium and discount zones in order to find out the correct fair value gap for taking entry into the market. We would draw the Fibonacci level from this higher low to this higher high. After drawing the premium and discount zones, we can see that these two fair value gaps are in the premium zone and the third fair value gap is into the discount zone. And along with that, the market broke the resistance zone which was formed before and made this fair value gap in doing so. And thus, there are higher chances of market respecting this fair value gap zone. And as you can see that the market respected this fair value gap. Now at this point also, a lot of traders would be removed out from the market. This is because the lower wick of the candle formed at this fair value gap reached at the lower end of the fair value gap where the stop loss of a lot of traders are rested. In order to not to get stepped out from the market into the winning trades like this, you must keep your stop loss below the fair value gap, as the market makers would try their best to remove you from the market to gather more counter orders. The market makes the fair value gap on both higher and lower time frame. But the market mostly respects the higher time frame fair value gap rather than the lower time fair value gap. The rookie traders lose their capital into the market due to this reason also. They would mark the fair value gap on one time frame, and once the market reaches at the FVG, then they would start to go long from this point, but the market does not reverse and continues its existing trend, which is why their stop loss would be hit and thus, they would get stepped out of the market. This is the reason we recommend you to analyze the chart of the market on different time frames rather than on only one time frame. Now, since we have learned all the basic concepts of the fair value gap, let us now learn the simple yet effective fair value gap strategy that would help you in making more profits into the market. The strategy that we are going to reveal in this video would help you in trading the fair value gaps into the market in a correct way. Now let us begin with learning this strategy. We would learn this strategy through an example so that you can understand it properly. So, here we have the Euro-Canadian dollar chart on 4-hour time frame. The first step in our strategy is to mark the higher time frame supply and demand zones. So, let us do this first. We can see market making big imbalance candles here, and thus, we would mark the demand zone from its previous candles. And then, we see market reaching at this demand zone. The market made a support zone here before it reached to this demand zone. This means that the probability of the market respecting this demand zone is higher, as this support zone was made to gather the counter order from the market participants. And as you can see, the market is going above after reaching at this demand zone. But we would not enter now as it is too early, and also, this move by the market might be a pullback and not a reversal. And instead, we would wait for the market to make a change of character in order to confirm that this is a reversal and not a pullback. The market made a change of character by breaking this lower high to the upside. By seeing this move, a lot of impatient retail traders would go long, but we won't do this. Instead, we would draw this fair value gap which the market created while making the change of character. And as you can see that the market has came to this fair value gap. We would use the concept of CE, which we learnt earlier in this video. The concept of CE helps us in initiating our long trade at lower price so that we can maximize our profits into the market. We would mark the 50% of this big fair value gap and would go long once it reaches at this CE point. Now let us move to the lower time frame, which is the 1-hour time frame. At the 1-hour time frame, we would set our buy limit order at the CE level. We would keep our stop loss below the lower end of this fair value gap and place our targets at 3 times the stop loss. Now here is an important thing that you must know. The market is unpredictable, and which is why we recommend you to keep your stop loss below this in order to not miss out the winning trades like this. Now let us see the result of our trade. The market hits our target point, and thus, we made nice profits by using this strategy. So, in this video we shared the simple and effective fair value gap strategy, but we recommend you to backtest this strategy before using it out on the real charts. Here we end our video. But before we do so, if you found our video informative, then like the video and be sure to subscribe our channel so that you never miss out any of upcoming videos that are being uploaded on the channel. See you in the next video.